I want to invest in something safe. Notice that I did that, like it's safe.
Absolutely.
Okay. For those of you listening, I just made the, quotation marks around safe. Gary, what's your advice?
Well, probably, first of all, the safest investment just about anyone can make is paying down debt. People don't view paying down debt as an investment, but right now, obviously, the rates of return are staggering. If you can take 10 or 12 or 15% debt and pay it down, that's the rate of return that you receive. And it's as safe as you can imagine because guess what? You're not going to have to pay anyone that money. It's not very sexy. People don't think about paying down debt and kind of brag to their neighbors about it, but it's probably the best investment and the safest investment anyone can make.
Okay. And Jack, for $10,000 that I'm going to need within 5 years. That doesn't mean in 5 years. I'll say within.
Gold?
Stop it.
No, I'm going to be
He's being
unsexy.
sarcastic.
I'm going to be unsexy too, and I'm going to say, but maybe a little surprising, and say a 10-year CD. And only a 10-year CD, of course, that gives you the right to get out of it with a small penalty. You'll get a higher rate if in 5 years you want to break that contract. You usually, for some of them, you can pay only 2 months interest, which is a good deal. You can get about 3.5% a year minus that 2-month penalty.
And that one that you're thinking about, is that the one through Ally?
I believe
CD?
that is the Ally one. We've written about this a lot. Our blogger, Alan Roth, has.
Yeah, I'm going to find it.
I think Jill is going there right now.
I'm going to try. But
Scroll down on the right, we'll find Alan Roth.
Hold on, here
I
we
don't
go.
think they can charge more than 3 months. I don't know if your research is.
I thought there was 6-month penalty. I think there's 6
No,
months.
I think he's right. I think the 5-year CD for Ally was a 3-month penalty. And he also he's got some great blog posts. He has best CDs, where to find them, and he has the whole kind of background about that. And yes, he also talks about where to stash your cash. So in that article, he does talk about the Ally Bank. He talks about that's a 5-year CD. It yields 2.69. Has a 60-day simple interest early withdrawal penalty. So only 60 days. Not bad. All right. I, however, am very boring, even more boring than you. When I was in the client business and clients would say to me, I won't need it for 5 years. Inevitably, 5 months later, they would say, where is that 10 grand again? I really need that. So I'm going to give you the experience of my life, which is always err. If someone says they're going to need the cash, they always are going to need it sooner than they say they're going to need it. So I would just be very boring and be in a higher yielding money market savings account and not worry about it. I don't really care about earning an extra $8. I really don't. I could care less. And I agree. I think paying down debt is wonderful. But if you need access to that cash because you have a payment,
if it's a line,
right?
if it's a line of credit, you have the access.
Unless
as long as they shut the line of credit, as long as they don't shut it.
No, they would never do that, Gary. Who would do that? All right, we got some questions. By the way, I'm reading from a piece of paper. If you send us an email, I will read that as well. Megan does this, so we have paper. We kill trees. Okay. Where's the best place for your money given the current state of uncertainty in the economy? Are the more illiquid investment vehicles such as non-performing housing loan funds. Let me do that again. Non-performing housing loan funds, the ones that are going to blow up maybe because of this whole foreclosure fiasco. Is that a good idea, Gary? Is that a good place for your money?
Well, unfortunately, tends to be, the kind of the key answer. For most people, no. You have an illiquid investment. You have an uncertain marketplace. Your risk tolerance would have to be incredibly high, as would your lack of need for liquidity. So, certainly for most people, it's not a place I'd be looking.
Okay. And Jack, do you think that there's any reason why someone should reach a little bit on the risk level to go to something like that?
Yes, if they have an enormous amount of money,
right,
and they're very well diversified across some risky, some not so risky assets. I mean, I heard and also, frankly, I think they need some professional help, or they have to be real good at this.
Mm-hmm.
I did hear the guy runs Double Line Capital, talking, a pretty smart bond investor, and he's buying these housing loans for 16 cents on the dollar. He thinks they're worth about 30 cents on the dollar.
Okay.
So in his case, great, but for most people, no, stay far away.
I mean, if you have a team together and you know what you're doing, I think this is an excellent opportunity. But the way they're getting packaged for the public is you're adding fees upon fees upon fees. You have all kinds of overrides. You have a lack of liquidity. You have all sorts of concerns, and it's a completely different scenario.
Okay, I got some more for you. Here we go. Henry wants to know, what's your opinion on the safe place to put my money that's currently in a money market account accruing 1.5% interest? My first reaction is, which money
Congratulations.
market is earning 1.5%? God. Anyway, Henry's 53 years old, and it's 10% of his investment assets. Check this out. The remaining 80%, which is 401k and IRA, are 85% in stocks. What do you got on that one, Jack?
That's a little on the high side for somebody
a little?
53.
I'm having like a nervous breakdown right now.
Well, remember, it's a 401k, so he's probably not thinking about touching it for
Oh my
20
God.
years.
Jack, I'm
right?
sorry, my friend.
Yeah?
I normally don't take you on. I mean, look, in a perfect world, people should actually have the more conservative part of their portfolio in their retirement account.
Okay, can you please explain that? Because I understand that for the people.
I was just breathing. I didn't stop.
All right.
When in your retirement account, if you lose money, you eat it. You don't even get the benefit of a tax deduction. And if you make money, sure, it's tax deferred. You don't have to pay tax right away. But when you take it out, you pay tax on all of it. You don't even get the lower capital gains treatment. Now, I say in a perfect world. In a perfect world, when you're allocating your assets, your shelters will be in the conservative investments. That's the 401k, the 403b, the IRA. And your other assets might be in equities, so that you can take advantage of the disparate treatment of gains and losses that the tax code affords. I mean, look, view taxes as your friend. It can mitigate your losses, it can make them less painful, and it can make your gains a little less taxing. So in this scenario, it seems like 80-some-odd% of his assets are in the retirement account, so we don't really have all of the flexibility to play it. But both the aggregate amount of money he has in equities kind of would be of concern to me, and also the fact that it's all in retirement accounts and none of it is outside.
So would we do 70-30? Probably 60-40?
Okay, I
53?
must be the biggest wimp in the universe, but the guy's 53 years old. He probably got his butt handed to him. I'm sure he didn't buy 85% of his stocks at the bottom, right? So let's assume that he's basically had this the entire way up and down. So I can't imagine. I would, probably maybe most 60-40. I would see if we could get some dividend producing stuff in that retirement account, and try to take advantage of the taxes that way.
I mean, you certainly would want to reduce it. But here's, I think one of the big mistakes that people do are look at individual accounts separately. Who cares what your 401k allocation is? Who cares what your IRA allocation is? We care about what your entire life's allocation is, because it's all your portfolio. So, the inclination is, let's diversify account A, and incidentally, we'll diversify B. But you got to look at A and B and C and put them all together and make sure in totality they're diverse.
And this is important for couples because often, you are restricted in what you can do. So your wife has a 401k with a lot of flexibility. She can find some good funds. You have one index fund in yours, so you're maybe the equity guy. She buys the bond funds in hers, that sort of thing.
Absolutely right,
Especially
Jeff.
if you're married to someone who's in a really sweet pension fund that has a nice guaranteed
We
account.
should all have something like that.
Oh, God, why didn't I do that?
Yeah.
Had I known.
Yeah, would be a good thing.
All right. So we agree. Holistic approach, look at all of your accounts. Seems to me, Henry, you got a little bit too much on the line there. Chill out, buddy. You don't have to make it all back in 1 minute. Okay, so Michelle wants to know, I have money invested in Edward Jones. It doesn't seem to grow any interest. Well, Michelle, this is such a funny question because we know nothing about Michelle. We don't know what she's talking about, do we? We don't know whether she's talking about her money market makes no money, her funds are not growing.
I think she's making one mistake that a surprisingly high number of people make. They think an Edward Jones account is a kind of investment, or a Fidelity account is a kind of investment. All it is the place that allows you to make investments.
Right.
So you can buy within that Edward Jones account anything. So you need to use that to create the diversified portfolio we've all been talking about here. Also, the 4 accounts bothers me a little bit. She says she has 4 accounts. I'm not sure why she does.
But she may have 4 funds in one
I
account.
see, yeah.
I mean, we don't know. But here's a great lesson, though. Most people don't know what the heck they have. Let's be honest. I mean, some people are great. The engineers walk in, they got the spreadsheets. I got it all.
The engineers have it down.
Awesome.
Perfect
what's
handwriting
awesome?
as well.
You know what the best is about the engineers? They have it all documented, but they cannot make a decision. It's so much fun to have that guy as a client. It's like, yeah, you've done all this analysis. Well, I guess you don't need me. He's like, well, I've done all the analysis, but I haven't traded in 8 years. So
Yeah,
that's
that's true.
analysis paralysis. So I think that there is, especially now, it's the end of the quarter just came. We're coming into the fourth quarter. You're going to gather up all your documents. How about opening your statements and figuring out what the heck you have? And if you don't know what you have, you're working with a broker at Edward Jones. Call up the guy or the gal and say, I need to come in. I know you probably went over this with me a million times, but I need it again. And don't be afraid to ask, right?
Right. I mean, look, at the risk of kind of encouraging activities with stockbrokers, the key, again, is to look at the entire picture. You can't look at one, even in this case, 4 accounts at one brokerage account and start making decisions about your whole world without looking at all of it. So when you're gathering your documents together, you have to gather together everything you have, all of your debt, all of your assets, all of your retirement accounts, and look at it all at one time.
Yeah, I wonder if we could give people a baseline to start with, and so that they can ask their advisor, okay, tell me why I should change from, let's say, 50% in a broad market stock index fund, 50% in a bond index fund. I'm not saying that's the perfect portfolio, but let's start there and then say, okay, why are we diverting from that? Why am I
Right.
paying an active manager? How's he going to beat that? Why am I
Right.
putting more in stocks? Why am I putting more in bonds?
I
That
think
sort of thing.
it begs the question that when you work with a broker, an advisor, fee-based, fee-only, commission, doesn't even matter, but ask questions because you're
You have to
paying
ask,
that
you have
person
to ask
something,
questions.
right?
Absolutely right.
I think people, though, they don't know what question to ask.
We're going to put together the, and I think I actually have this, the 10 questions you must ask your financial advisor.
Yeah, I think
I'll ask you that, Gary,
it's
later.
out there.
That's good. But anyway, we've done that. So let's get on to the next one. MJ, Michael Jackson,
Oh,
potentially.
wow, that's news.
Fantastic.
I've been reading about tips.
Yeah.
Nah.
It's not Michael Jackson.
Little late.
Okay.
Little late, Michael.
Treasury insured protected securities. It's do you consider them a good investment for people who are risk averse, Gary?
Well, the tips basically are protecting you against inflation because you're getting a fixed rate of return plus the rate of inflation. Parenthetically, that fixed rate of return is minuscule, and the inflation currently is even less. So the rate of return is incredibly low, but it is very protective against rising interest rate environments.
Right.
At the current time, I don't particularly like tips because the yields on them have plummeted because so many people have rushed to it because we've had this simultaneous fear that inflation is going to be rampant tomorrow and the next day deflation is going to be rampant. So we don't know what we're doing, but we're running out and buying, protecting against both inflation and deflation
At the same time,
simultaneously.
right? So Treasury inflation protected securities, by the way, if you do want to buy them, there is actually an exchange traded fund, TIP.
Correct.
CIP. But
There are good no-load funds. Vanguard has a good tips
right.
fund.
But the reality is that you are really paying up for protection.
Right now,
mean-
you're paying up more than you ever have since tips rolled out, which was, 10, 12, 15 years ago.
So I don't know, not one of my favorite,
It's a very expensive insurance policy.
I would say.
One thing that this brings up, though, people think of risk in terms of stocks, things that can go down, and there are other risks out there. One of them is inflation. That one, finally, people are becoming aware of it, but sometimes people will go into the safe investment of bonds or a bank account or something, not realizing that the long-term risk, it's actually, frankly, it's a guarantee that they will lose money to inflation
absolutely.
in, say, a savings account.
People have often come to me and say, well, I want to lock up this 25-year bond. It's paying, let's imagine right now in the current environment, it's paying 4.5%. That's staggering. That's tremendous. And I said, if interest rates go up 1%, you'll lose 20% of your value.
Well, people don't realize they can get clocked on bonds.
Yeah, but then what's the response you hear? The response you hear is, oh, no. I won't lose anything as long as I hold it to maturity.
Right.
Well, that's one of the great lies of all time.
Yep.
If everyone else is earning 5.5% for the next 20 years and you're earning 4.5%, guess what that means? It means you've lost about 20%.
Well, and when
your
people,
buying power is
well,
plummeting.
and you're probably paying a premium. You're paying over. Yes, you will not lose it if you bought it at 100, but if you paid 108, you're going to lose that $8. That's the deal. Sorry. Good question from Jennifer P. She's got $30,000 that she would like to get better than 1% return. Imagine that.
She sets the bar nicely. You know, when expectations are low, you can meet them. Right?
But so we were just talking about tips. We don't like tips, but with 30 grand, let's assume that Jennifer has a little bit of time because she's talking about investments. She didn't say that, she's got some money to invest. And she would like to be on the lower risk side, but a better return than 1%.
Well, look,
seems reasonable.
I'd like to kind of expand the question a little because I think you can't only look at it as exclusively investments. But to the question of how do you raise the rate of return with very little risk? Look, there are money market funds that are paying 1.5%. Discover Bank, it has a 1.5% money market fund. There are top quality short-term bond funds, Vanguard short-term investment grade. It's yielding 2 and change percent. It has some very modest volatility if rates rise. So there are many choices there. But if someone has a chunk of money and they're not using it, one of the first questions they should ask around the same time that they're asking, how should I invest it, is should I be looking at other tax-saving opportunities, whether it be funding a Roth IRA or a regular IRA or increasing my 401k or doing any of those sets of things, because increasing your financial position and helping your financial picture is not only about rates of return, it's not only about tax savings, it's about looking at all of the issues simultaneously.
Yeah, if she's got a child and she lives in New York, puts it in a 529.
Fantastic.
Then she's just saved on state taxes.
And she doesn't have to pick a very risky investment within the 529. She can pick the fixed account inside the 529. So a lot of things we need to know about you. It's funny, we just got a question from Robin. Are I bonds a good investment? So I bonds, would you like to do the successor to the AA?
Yeah, I mean it's the same sort of a play on inflation. And for the right people, the beauty of the I bonds is the ability to buy it in these small increments.
Right.
And the ability to buy in small increments has its own advantage. Some people save when they wouldn't have saved if they couldn't buy it in small increments. But normally I'd be looking probably elsewhere. But by elsewhere doesn't mean you should freeze, put the money back in your pocket and end up spending it, but truly try to find another alternative.
Interesting. I love these accounts. The hey, Roland, put this up if you wouldn't mind. This is not a commercial for ING, but ING was really revolutionary in starting this online savings account, the Orange savings account. So we have a question here from a MoneyWatch user who didn't leave his name, but he or she actually has several investing questions for us. I have an ING savings account for my emergency fund. What do you think? What do you think?
Sounds good to me.
Me too.
Very liquid.
Not bad.
Easy. I'm playing the market with a capital M, which I like, with mostly ETFs. Thoughts?
In the right allocation, with the right pick, and if they're ETFs can mean anything. They started out by being merely index funds competing with the S&P 500 index. Now, an ETF could be a wise decision, or you could be investing. You could be investing in Malaysian toothpick manufacturing
with 3 times the
I just
leverage.
bought that.
You did.
Yeah, MLT or something. Yes, that's good. I agree. I think that the first part of the ETF revolution was amazing. It really was. It was cool because an exchange traded fund. Here you are. You've got a way to trade intraday instead of the sort of the boring old mutual fund priced at 4 o'clock. And which, usually keeps
you
most
like your
people
excitement in your investing.
a little bit.
Yeah.
I like opportunity. But I think that ETFs were cheap. They were good for me and for clients. When I was working with clients, it was good because if they had a big chunk of money and you were putting money to work, it was an efficient way to invest, right? But I agree. There are all these weird permutations now of ETFs. So you got to be careful. You can't just be buying 2 times the NASDAQ and think that nothing's going to happen.
Right.
Woohoo!
I will say that because this is MoneyWatch.com, the words playing the market do raise a red flag for us. Generally, we advise against that. And
you know what? You're a killjoy.
Yeah, I know.
You absolutely are. You know what I would say to that is that if you are playing the market with some small percent of your portfolio, I can live with that, right?
Absolutely.
Not
from a behavioral sense, it's great because when you feel I have to do something, you do something with that. Any losses will be minimal, and you protect the bulk of your portfolio.
I used to like to say that the amount would be 5% of your investable assets is what you can quote unquote play with. Anything more than that, you're going to start feeling it when it happens, when it moves against you. So. I think you feel it anyway, don't you?
You do feel it.
You do.
As I often say, the pain of a loss is much greater than the joy of the game.
No, that's for sure for me. Okay. The other thing is that this guy gal is leaving the job after 6 years. Are you choking over there, Gary?
It's
Here,
sad
take
that
my
he's
water.
losing the job. Thank
there
you.
we go. Okay. Leaving my job, 401k is a handsome sum. After 6 years, how much could it be? I would love to cash out and dump it in the market. But the most cost-effective option is to roll it over, right? Should I do a traditional IRA or a Roth IRA?
Well, we're mixing all of our various terms just a little bit. First of all, you can cash out by rolling it over. If you
Right.
just merely take the money out, you have to pay tax on it. And if you're under 59 and a half, there aren't other exceptions. You'll also pay a 10% penalty on top of that. If you wanted to play the market or invest in the market, you could roll it over to an IRA and do that. I mean, you could do it in a self-directed IRA. Now, the secondary question is, should they do what's called convert it to a Roth IRA?
Right.
And that's something which is particularly attractive this year, but it depends on a lot of different factors. We're not going to be able to cover all of them, but what is your current tax bracket? What's the expectation of your rate of your earnings going forward? And it's possible he or she could do a little bit of each. They could roll it to a traditional IRA and convert some of it to a Roth. Now, as you know, a Roth IRA, the interesting thing about it is that it grows completely tax-free for the rest of your life. I mean, it doesn't get any better really than that. But the problem with converting is that you have to pay tax on it when you convert.
And you can't pay the tax from that rolled over 401k without paying a penalty. So basically, it's a cash flow issue. You got to have some cash on hand.
Yeah, the key on the Roth conversion, and one of the key indicia of when Roth conversions make sense, are that you have to have the cash on hand, as you say, Jack, ever so correctly.
Oh my God! Why don't you guys go make out in the
No,
corner?
we do. You know, we
He's
do
being
all.
sarcastic,
Uh-huh.
Joe.
No,
Yeah,
no,
I know.
this is the only
Really.
time it's true. You actually know what you're doing. And
Actually.
no, the key is to have the cash outside in order to pay the tax. Otherwise, Roth IRAs are a heck of a lot less attractive.
I hate to do this. I just want to say that Susie thinks you're a good guest. Susie in our chat room thinks you're a good guest.
Love Susie.
Do we know what her last name is?
Yeah, you know who Susie is. It's our Susie.
Wow.
So anyway, just want to let you
You
know.
own a Susie?
We have a Susie. We
It's
have a
not the Susie you're thinking of.
No.
No, not that one.
No.
No, it's not that Susie.
Yeah, she canceled the show I was going to be on with her for another time.
Interesting. Okay. So most importantly, you leave a job, you got your couple of big options. One is you roll it over to where your new plan is. The second is you move it into an IRA rollover. Second set of choices, do I convert it or not?
Or
Run the
keep it
numbers,
where it
Or
is.
keep it where it is, right. If you've got a great plan, it's sitting in a Vanguard
There's
fund.
about half a dozen great plans in the country. If you're
Yeah.
one of those,
Yeah, you're lucky, exactly.
I have to do this
Do
for
it.
my previous job, and I've frozen. I haven't done it yet. I got to do it. You guys have inspired me.
Really?
Yep.
This is very
that's
exciting.
why we're here, Jeff.
Yeah,
We
but
are
I
your-
still, it's IRA or the CBS plan.
You know,
I
the
don't
cobbler's, what is
Yeah.
that? Cobbler's
Yeah,
shoes
mhm.
thing?
Kids have no shoes or something
Yeah.
like that. All right. I don't think we should discuss the CBS plan here. Okay, Preston says, I'm loaded up on blue chip stocks and I have a balanced portfolio that outperforms but somewhat follows the Dow Jones Industrial Average. Okay, hang on 1 second. There is no way that he's got blue chip stocks and a balanced portfolio that track, like, is he saying his stock portion?
It's balanced among all of the Dow. of the
Exactly.
blue
I've got
chip.
30 stocks.
Right.
And so we're not sure about that. Okay. Preston wants to know if a windfall of cash came my direction, say 30% value of the current portfolio. He's got $1 million, he got 300 grand. Okay. Where are the best places to invest given that I think stocks are setting themselves up for a beating next year?
That's easy. As soon as they take the beating, you buy stocks.
Just and tell us when that's going to
Please,
happen.
Yeah, but let's. We think it's going to be a beating. He has his entire portfolio in blue chip stocks.
So what's up?
I mean, if it's in blue chip stocks, he doesn't have a heck of a lot of foreign exposure, except for those blue chips who are investing
Coca-Cola.
overseas, right? Coca-Cola,
Right.
And he has no bonds. I mean, I can plug a few. There's a few problems there.
Yeah. And if you really think that stocks are going to plunge, then sell some of your stocks.
Exactly
And by
right.
the way, why not pay your capital gains at 15% right now? Thank you very much.
It's a beautiful thing.
Right?
By the way, if he has a big capital gains over the last 5 years, we should touch base with him after the show.
All right, Preston, let us know. Gary wants to talk. Okay, finally from Elizabeth. I'm 57 years old. I have no debt, own my own home outright. I have no children. I have approximately $400,000 in a 401k, which I plan to roll over into a Roth IRA in the next couple of months. I also have $400,000 in cash. Doesn't she sound gorgeous?
I'm
in love with this woman.
I was going to say.
I love her. So here's where she stands. So she's got 400 grand in her 401k, 400 in cash. I don't know if
she's working.
I'm not sure. That's the only
Okay,
thing. It's
so
not
let
clear to
me just kind of stop. Step away from the ledge.
Yep.
Roth conversions, as you know, you don't have to do it all. And why won't you want to do it all? Because if you happen to find yourself not in the top tax bracket, which I'm betting she's not, if you do it all, you will be in the top tax bracket. So you will actually, she could run the risk of paying tax on the Roth conversion at a higher rate than she would ever pay tax on if she delayed it. So that being said, doesn't mean do nothing.
Right.
Take a look at your taxes, take a look at your marginal tax bracket. This year we have a unique opportunity where you have the choice to either pay the tax this year with the amount that you convert from an IRA to a Roth, add it to this year's income, or you have the ability to take what you converted this year and spread it equally over 2011 and 2012. So if she took, let us say, $50,000, $25,000 would be added to 2011 and $25,000 would be added to 2012, giving you the ability to take out more money without dramatically increasing your tax bracket. So this is we can't have a knee-jerk sort of reaction. You have to look at your tax return, project out what your income is. Rarely, and there are exceptions, but rarely would I do a full conversion like that. Look, some of my clients who are particularly well-heeled, I know they're going to retire in the top bracket. They have millions and millions of dollars. For them, I might do a total Roth conversion at a tax bracket that will now seem to be, hopefully tax rates will be going higher. Sorry about that. That's the liberal in me.
Okay.
Sorry about that. But I work around it. I plan around it. But for that person, converting it this year would make a lot of sense.
Right. So, do you think it's reasonable for Elizabeth to talk to her tax preparer to do those kinds of calculations? Let's say she's just on her own doing her own stuff.
If she's on her own, you need to get advice. Whether it's an impartial advisor who understands tax, whether it's your tax advisor, whether it's a broker who understands tax. There should be one out there.
There's a couple. Or three.
One thing I would throw in there, just in general, the older you are, probably the less advantage you're going to get from the Roth conversion, right?
That might be a good generality, Susie.
Although my
that's basically the harshest thing he could say to anybody.
But I think he's saying that obviously, if you were going to never tap that money and you're planning to leave that money to your kids, it wouldn't matter anyway, right? For the Roth.
I mean, but you could be, look, I have people who are in their 70s where Roths make sense. If you know the tax brackets are going to be similar, you have the cash to pay it. If you live a day, it's a day that you were able to take advantage of it. But you're absolutely right. That is one of the factors.
Thank you, Gary.
No, Jack, you're on it.
By the way, you're now digging yourself out of a pretty big hole. I think you're buying next time. Okay. Now, the other thing about Elizabeth is that she says she's got a quarter of her 401k in emerging markets fund. And from what I see and what I don't see in Europe and elsewhere, I get the impression that I should move out of that fund. Should she move? Let's say she's got a quarter of her 401k, of that $400,000, is in an emerging markets fund.
Wow.
Now, I don't know what else she has. The problem that we don't know is that we don't know whether it's a quarter. We don't know if it's 100 grand in emerging markets and, another 300 in bonds. Mm-hmm. Right? But let's assume that she's got 25% emerging markets, 25% U.S. markets, and 50% in bonds. Let's just pretend she's 50-50. How do you like that allocation, Jack? Do you like having, and of course she's got 400 grand in cash
as Gary
outside.
pointed out, we like to be holistic about this. So we're talking roughly 12.5% of her total assets are in emerging markets. I would probably be inclined to rebalance that lower. I think it's a little steep, but I think lots of people listening to this, I think most people probably have too little in emerging markets.
Right.
So can we push Elizabeth down to 7%? I think that's probably where I'd go. Most people need to nudge up from 0 to 5.
No, that's true. But let's add two other pieces. One that I alluded to, that her retirement account should be a little more conservative.
Right.
And let me add yet another reason why emerging markets or foreign stocks, if you can, should not be in the retirement account. Because there's foreign taxes that are being paid on it. And if you pay those foreign taxes outside of your retirement account, you get what's called a foreign tax credit, meaning the IRS gives it back to you. But if you pay those taxes in your retirement account, goodbye.
Right.
You never see it. The IRS doesn't give it to you. And, last night, well, I might believe in higher taxes, but I also believe in you getting all the taxes back you're entitled to.
Use the code to your advantage.
Code is your friend.
And everything legally, but use it to your advantage.
Absolutely.
So this woman's in a perfect position to do that. She's got $400,000 in cash outside of her retirement account.
That's,
Yeah.
That's my point.
They are so sweet together, aren't they, Jess? Okay. A few minutes ago, someone just said, talking about potentially the stock market falling in a major way. And someone in the chat room, my boss, wants to know whether stocks will if we think stocks could be taking a beating in the near term. Jack, what do you think?
I think anybody who answers that question with certainty is either a liar or either way has a 50% chance of being right. The key point here is you do not know, and you have to structure your portfolio in such a way so that if stocks do take a beating, you won't panic and sell. So do that gut check. We just saw it. It was a real good opportunity in March of 2008 to know, or 2009, to know what you're going to do. If you sold back then, you got too much money in stocks.
Or even more recently, if you sold during the flash crash, if that completely spooked you and that made you walk away, that's a really remember how bad you felt that day.
Absolutely.
And that's maybe a good reality check for you.
What I would say, if you had to pin me down, and I'm saying this as somebody who doesn't believe you can predict such things. Yeah, I think over the next year or two, will we probably see a harsh correction of some sort? Yes, that's not a real risky statement because it happens a lot. We've been trading in a range recently. There's a good chance something will happen. I also think, given what the market's been through, what are we trading at? 12 times future earnings in the S&P 500. I wouldn't be surprised if it goes down a little bit, especially if bonds pick up. But that said, generally, if you get to around under 10 times historically, that's been a fabulous time to buy stocks.
What do you think, boss?
Jack said
Ditto?
it. Jack, ditto. No, look, do I think we could see a correction? Absolutely. When it would happen, I'm not quite sure. You really have to ask yourself, how surprised would people be if all of a sudden the market turned down 10%? Everyone would turn around and say, of course, absolutely. Right. It doesn't mean that it's predictive. But if you have concerns about it, if you think you're overweighted, if you have too much in the market, now's not a bad time to lighten up.
Yeah,
but if you're sitting on the sidelines, you can't freeze.
Right. And you've got to have some game plan to figure out how you're going to get back. And I would say, as the former trader among the three of us, that I would be very interested to see whether there's a little bit of action right after the next Fed meeting. Because if they announce quantitative easing, if they say they're going to buy a whole bunch of securities, that may be happy for the market, or maybe it's already built in. Maybe it's, hey, I bought the rumor, now I'm going to sell the fact.
Yeah, every piece of news you can spin the absolute opposite will occur.
Exactly. So you got to be careful. By the way, Preston weighs in saying China and currency valuation has to impact stocks negatively. You know what I always say about that? All the things that have to happen, you could go broke waiting for that have to happen.
Bond rates had to go up years ago.
They had to go up.
Had to go up 2 years ago. Everyone said there's no way. So, Preston, I totally get that there are some sort of larger issues. The question is, as you guys have said, the timing, and you don't want to have to outguess, and you don't have to outguess. You don't have to be perfect or nearly perfect like Mr. Halliday.
Can we quote the
Nicely
famous?
Done.
Thank you.
Nicely done.
Thanks.
The market can stay irrational longer than you can stay solvent.
That's
Or
right.
liquid, yeah.
Okay, now what else do I have to tell you? I think we're almost done. By the way, my boss thinks that you explain things very well.
And just for Susie and your boss are the same person?
No. Susie is a different person.
Okay,
Susie's
great.
more of the
Bring it on, baby.
Yeah,
that's good.
But M says you are very good, and you are very good.
Thank you.
Hey, Gary, if someone wants to find somebody like you, not you, because it's not infomercial for Gary and Co.
No.
But where can they find a fee-only advisor?
Fee-only. Well, first of all, what should you be looking for? You should be looking for someone who's fee-only, who doesn't work on commission and doesn't get a kickback or referral fee. You want someone who's comprehensive, because there are money managers that are fee-only.
Yeah.
Leave the money at my door, get the heck out of the house. I'll manage it and we'll figure it out. But you want someone who understands investments, taxes, insurance. I would certainly. I'd suggest NAPFA, the group that I was chairman of, the National Association of Personal Financial Advisors, NAPFA.org. And these are, there aren't tens of thousands because 98% of people in this field are salespeople, and of the percentage that aren't, they're normally just money managers. But NAPFA is a national organization of fee-only comprehensive financial advisors.
And here we have the website up for you. So NAPFA, N-A-P-F-A. And you can find someone in your area that's perfect for you. I don't know who this person is, but
She's prettier than Gary.
Well, most are.
Not
but,
necessarily.
Thank you.
Anyway, so go to napfa.org.
And we will throw in that our own Jane Bryant Quinn, the
Yes.
Queen, has actually recommended NAPFA also.
There you go.
Yeah.
It's very good.
Yeah.
It's all very
all good.
beautiful here. You will come back?
Oh, my pleasure. Love this
Weekly?
place. You know, the
Maybe
stipend's
not.
a little light, but
If we do it late enough in the day, then Jack will buy
I'm
drinks.
missing my daughter's soccer game at this moment.
What position does she play?
She's offensive.
Really?
She's
How
very
old is she?
awesome. 11. So,
Interesting.
but I love
Jill
being
was
here
a
with you
star
guys.
college soccer player, by the way.
Were
no
you
kidding.
really?
Yeah.
That's way back when. Okay, that's enough of that. If you've got questions for next week's show, send us an email. Ask the experts at moneywatch.com. Ask the experts at moneywatch.com. And we're moving to our earlier time because Megan would like to eat bonbons earlier in the afternoon. She said it's important for her to be able to watch Oprah.
Oh,
And so that's the move. The move will be to 2 o'clock. Is that right? 2 o'clock Eastern time, 11 for you folks on the West Coast. You can have early lunch with us. Gary Schatsky, thank you so much for joining us.
Big pleasure.
I'm Jill Schlesinger.
I'm Jack Otter.
And thanks for watching Ask the Experts. We will see you next week.
Look at them yo-yos, that's the way you do it. You play the guitar on the MTV. That ain't